Nick, Axford, CBRE, thank you for joining us at MIPIM. You've just launched the CBRE investment findings for Europe. Can you tell us what you discovered in the report?
Yes, I mean, clearly in the market we've seen quite a strong recovery in terms of investment activity coming through the latter part of 2009. Certainly our experience is that that's being continued into the current quarter, and we expect certainly the first half of the year to be pretty strong. Our investor intention survey spoke to over 270 European investors about what they were thinking, what their concerns were, and what their focus is going to be over the next year or two. And what clearly came out was a very strong focus on the UK. A third of respondents saying that they thought the UK was the priority investment target this year. And then another 36% saying that France and Germany were their targets, split equally between them. So quite a strong focus on those core, more liquid markets. Interestingly, 16% highlighting Central and Eastern Europe as being the priority. Now, there'll be some regional specialists in there, but clearly there is interest coming back into those markets as well.
And I think the report found predominantly prime assets were the focus at the moment.
Yeah, very much so. I mean, we asked investors when would be the right time to invest in prime quality assets, and 3/4 of them said either the first half of this year, which was most of them, or the second half of this year. So now being seen as the time to get in at the prime end. But when we asked when was the right time to get into the secondary area of the market, much more hesitancy, relatively few saying the early part of this year, and actually the majority highlighting 2011 or even 2012 and beyond, so much more caution around that secondary area of the market.
There's been a lot of speculation at MIPIM this year about the banks and what they're planning to do with unwinding their property portfolios. Did you look at that in the report as well?
Yeah, we've actually launched a report today which specifically looks at the scale and the segmentation of that market. We estimate there's around a trillion, just under €1 trillion of real estate debt due to mature over the course of the next 10 years, about half of that due to mature over the next 3 years. So, yes, quite a significant issue there. What we've tried to do in the report is to segment it down, because a lot of that debt has very different characteristics. Some of it's very long term, some of it's relatively low loan to value secured on good quality assets. So by no means all of that debt is distressed. But what's also clear is that there are some very significant proportions, around 40% in total, which is poorer quality property, higher loan to values. It's most likely to be generating quite a lot of distress. And I think what we're starting to see is it's taken the banks quite a while to get their head around where the market is, around what their own particular loan book looks like. They're coming towards the end of that process now. They've now got a better handle on where they stand, the fact that the market has in many cases stopped falling in value terms now, so that they have a bit more stability to work from. They're starting to now put in place the plans and actions to deal with the situation, and in some cases that is going to mean asset sales, particularly the better quality good value add assets that we're seeing investors focus on. Those we expect to see some increased flow of product back to the market from the banks. I think the bigger issue they face is in that secondary area, whereas we saw from our survey, investors more cautious, not so much demand and lower values, and there it's going to be far harder for the banks to deal with the problem by selling the assets. So we're already seeing, and Lloyd's a notable example recently, announcements about setting up joint venture vehicles, ways to asset manage those assets through the course of the next few years, because it's going to take them a long while to exit. So setting up specialist vehicles to be able to work that through.
Nick Axford, thank you very much.